It's time to spotlight Morgan Stanley as shares are rising to new all-time highs today. Joining us now is Tony Zhang, the chief strategist at Options Play. Tony, thank you for being with us. Now, what do you think is behind us seeing Morgan Stanley on this all-time high run?
So I think there are multiple factors here. First of all, lower interest rates overall, I think, is going to generally be better for the financial industry. So that's a good tailwind to have for the overall sector. But if you look at Morgan Stanley specifically, their deal-making side of the business and the wealth management business is really what I think has been driving the business for the last couple of years. And we're starting to see some significant interest from investors in that particular side of the business. They recently have just reauthorized another $20 billion of share buybacks. They raised their dividends recently, so they're focusing on profitability and returning cash to shareholders. So I think all of those things combined is part of what's driving this interest in Morgan Stanley as a company outside of kind of the sector tailwinds that we're currently seeing from a macro perspective.
And so with those macro perspective tailwinds that you were talking about and the headwinds as well, Morgan Stanley specifically outside of the share buybacks and the dividend, what makes you bullish on Morgan Stanley compared to other financials?
Well, I mean, the wealth management business is a big part of Morgan Stanley, and you simply with stocks at all-time highs and bonds rallying as well alongside that, you really just have asset prices that have been driving the wealth management side and fees for that side of the business. And then, trading ultimately has still been a pretty strong part of their business as well. And then M&A activity continues to be relatively strong here in this macro environment. So when you combine all of those three things together, on top of the self-directed side with the E-Trade business, they just overall have been operating a strong business. And then from an efficiency perspective, profitability is something they've also continued to focus on, and that's really why I think a lot of investors are continuing to like Morgan Stanley. And even from a valuation perspective, it still looks quite inexpensive overall. You're only trading at around 16.5 times forward earnings versus roughly 25 times for the industry in terms of capital markets. So, you have a strong business, you have an efficient business, yet it trades at a valuation that's actually at a discount to its peers.
And since we're in the wake of Fed Day now with the rate cut coming yesterday, how will the cuts impact Morgan Stanley?
Yeah, so generally speaking, lower interest rate environment is definitely going to be beneficial for just general loan growth. Like I said, M&A activity is also something that we expect is going to be beneficial in a lower interest rate environment. And those are some things that are going to benefit Morgan Stanley from that perspective. Earnings momentum has continued to be a thing, has been strong for Morgan Stanley. They've returned 18% in terms of their return on capital here, which is relatively strong here, compared to their peers such as J.P. Morgan and Goldman Sachs, and just the balance sheet that they've continued to focus on profitability and returning that cash to shareholders.
And year to date, up about almost 27% as I just take a look at their chart. Do you think this breakout will continue to the upside?
Yeah, so we've got that major breakout here above that 150, and you can also, the 140 was the major breakout area earlier this year. You had another breakout here above the 150, a smaller one here just from a few weeks ago. So I think this has a lot of room to run here to the upside as a result of those two, call it double tops, right? You have one major double top from earlier this year. You have a small double top from just a couple of months ago. These are all really strong indications. And then on top of that, you have that relative strength. Morgan Stanley is outperforming the financial ETF, XLF. It's also outperforming the S&P 500. So when you see that type of relative strength as it reaches new all-time highs, that is what gives me the confidence to believe that this has a lot more room to run.
All right, so we've walked through the technicals. Can you walk us through your bullish trade for Morgan Stanley?
Yeah, I think in this type of market environment, the best way to play for upside is to use something like a call debit spread. And the reason that I want to do that is because I want to limit the amount of risk that I take because we are at all-time highs. We're effectively buying high and hoping that it goes even higher. So whenever I do that, I want to reduce the total amount of the stock's value that I'm risking on this particular trade. So I'm going out to October, looking at buying the 155, 165 call spread. Earlier today, you can pay a little under $5 right now because the stock is so strong here. Even just today, you're going to pay a little more than $5 for that debit spread. This is really where on 150, a nearly $160 stock, paying about $5, you're risking in this particular case about 4% of the stock's value. This way, you're limiting the downside risk. And using a debit spread like this, where you're straddling the current price, you're limiting also the time value or the time decay factor of an options trade that you're paying when you're buying an option. This way, using this call debit spread, I can basically take a long equity exposure while limiting the downside if we do get a pullback here, whether that's stock specific or just the overall market. Given the fact that we are near all-time highs, there's always a higher risk of a pullback here, whether you're looking at the individual stock, you're looking at the overall market as well.
All right. And so with that said, I want to move away from financials and into another sector here, into healthcare. My previous guest had said he saw a lot of opportunities in healthcare. So I'd like to get your outlook just for the healthcare sector on the whole, and if there are any specific names that you like in that space.
Yeah, I mean, you have to keep an eye out here for healthcare, right? Just because we are entering an environment that, generally speaking, is better for defensive positioning. Especially when you go into rate cuts, you have a labor market that's slowing down here, and healthcare, from a sector perspective, is trading at the lowest valuations we've seen in a very long time. So there are a lot of opportunities from a valuation perspective that I really like, especially if you look at the major health insurers, whether you're looking at United Health, but I specifically like Elevance, which is the second largest health insurance company behind United Health. They recently just bottomed out and seemingly formed a bit of a bottom and broke out above a major resistance level, that $300 level, trading at a valuation that I think is quite attractive here as well. Elevance trading at around 13, 14 times forward earnings. That's really kind of actually, Elevance is trading close around 10 times forward earnings. And these are the types of valuations that we haven't seen these health insurance companies trade at for quite some time, with net margins that are actually far better than the industry. So for those reasons, I really quite like Elevance from a timing perspective. And then just the valuation is looking incredibly compelling with this kind of what seemingly like these insurance companies are hitting a bit of a bottom.
And I know there's another one that you like too. You like Gilead Sciences. What about them is appealing to you?
Gilead is trading at 13 times forward earnings, but if you look at growth expectations, Gilead is head and shoulders above its peers. You're looking at EPS growth that's expected around 24%, revenue growth around 3.5–4% here, which is roughly in line with the industry. But what really is attractive for me for Gilead is their profitability. Net margins are north of 21%. So, they generate a fair amount of free cash flow. It's trading at a valuation that is effectively in line with the industry, but they're growing faster and they are more profitable than the industry. And for those reasons, I really like Gilead here, especially on this recent pullback here towards this 110 support level. I think the risk to reward for adding some bullish exposure here for Gilead looks quite attractive, especially when you look at the timing and the valuations.
Yeah, and Gilead trading right above that support level at 113.14 right now. We've talked some of your potential winners here and who you're bullish on. Is there anyone you're bearish on right now?
Yeah, there was one name that I really in this type of market environment, typically you would think would be a good performer here in a more defensive nature. But Philip Morris, tobacco companies have have struggled a little bit here, especially from a profitability perspective. You look at Philip Morris, this is a company that had profit margins that were north of 30% a couple of years ago. They've really struggled with profitability in the last couple of years. Net margins are now around 21%, which is well below the industry median. But if you look at valuations, Philip Morris is trading around 20 times forward earnings, which is significantly higher than the industry trading, which is somewhere around 15 times forward earnings. So when you have a company that's not growing much faster than the industry, is actually far less profitable or efficient than the industry, yet it trades at a valuation that's 33% north of the rest of the industry. That's really where I think there's some downside risk. And if you look at the stock chart here, it's recently started to deteriorate a little bit from a stock price perspective. It's broken below that 170 call it resistance level, support level that's now become resistance. Or if you look at it just from an overall trend line perspective, it broke that trend line back in mid-June, and it started to struggle here. And I think this is really where investors are paying attention to the fact that Philip Morris is struggling from a profitability perspective. There's obviously a lot of stigma around the industry as well. We know that tobacco use overall in the last decade has continued to decline, especially with the younger generation. So I think this is one that I like here more to the downside at the moment.
Well, yeah, Philip Morris down 2% just today, trading at 162.90 right now. Tony, we appreciate you being with us today. That's Tony Zhang, our chief strategist at Options Play. Thank you again for walking us through some of those picks and spotlighting Morgan Stanley for us.